Good morning. Okay, this place is scarier than it looked when I was sitting in the front seat. I watched Nina try to break the ice, and I was wondering what was she seeing. I see it now. First, sorry, you're not going to find the guy in that picture if you're looking for him. That guy is gone, thanks to the stress of trying to figure out what the future of banking is. I spent the last week trying to answer the question, and I finally got to the answer last night. I have absolutely no idea what the future of banking is. And if I did, I probably wouldn't be standing here giving some keynotes. On a more serious note, I think it's one of the most difficult questions to answer. And the reason is not because we don't have enough sense of what is coming at us. It's because we keep thinking there is one future of banking. We keep thinking at some level we'll figure out just this one solution. And that thinking has gone into how we have designed for banking. And probably explain why so many of the designs have failed. So for instance, the future of banking in Brazil is Nubank, and there's no arguing with that. But the future of banking in China is probably WeChat. There's nothing you can do about that. In Europe, it's less obvious. I don't know if it is Santander or it's going to be Revolut or Monzo. But every unique environment, every ecosystem is going to have to figure out what that future of banking is. And so I decided to answer a different question, which is, what is the likely future of banking in Africa? Even that is a broad question, but I think it's a lot easier to answer when you sort of look at economies that are similar in nature. There's a context to be set. If I'm to answer this question in the context of Africa, there's a context to be set. None of this is unique to Africa, but I think every one of these is heightened in Africa. We talk about a low trust environment. When you have low institutionalization, you have low trust. So it doesn't mean that trust is different elsewhere, but the existing institution means that you can actually deal on trust. I was speaking to a couple of friends last night, and I said, the idea that you could go somewhere, write a check, drop it, and take value and walk away, it's never going to happen in Nigeria. Nobody who has never met you before is going to take a checkbook from you. And that explains why instant payment, for instance, which is something that is not particularly valuable in Europe, is incredibly valuable in Africa. But businesses in Africa would actually slow down significantly if we didn't have instant payment. The only reason why two people who have never met before could transact and move on is that they could get value instantly. And that is not going to change. I don't see that significantly changing. So whatever future we think about for banking in Africa, must understand that a low trust environment requires a certain level of confidence to be built. So the technology we think about should be technology that helps strengthen the trust level. There is a low income environment, and this is kind of much more important now that we are all adapting the same technology. It costs the same thing to put your data on cloud and to process your data, to almost the same thing to write the algorithm that would, do risk decisioning for you. But when you deploy the same solution to the continent, you have to charge far less for it. And so even though it's exciting to think about what we could do with AI and all the other options coming up, we need to understand that you are taking it to an environment where even those who are financially included are anywhere between $3,000 to $5,000 per capita income per annum. And those that we genuinely want to financially include are even way below that. So you've got to think about that when you think of what the future might be. There's also the conversation around weak infrastructure, which means that some of the evolution that we're seeing that relies heavily on stable, reliable, predictable infrastructure may not scale on the continent. Not without scaling investment in power, without scaling investment in telecoms, without scaling all the other underlying investment that drives progress. This is now creating a high dependency on technology. And I mean dependency not just between, for instance, banks and the fintech, but also between the continent and elsewhere. One way to think about this is when fintech in Nigeria raise money on the continent generally, a huge part of that money goes right back into paying for technology or into sales and marketing or into social media advertising, right? So what is happening is you're trying to create value, But increasingly, it's going to be difficult to repatriate value because much of what you've spent doesn't actually create domestic growth. And there is the fact that if you are thinking about financial services in the global terms, increasingly the continent is struggling to pay for the services that it can consume. So it's not enough to envisage what services you can deliver on the continent. You have to imagine what is the reciprocal services that the continent is going to deliver over a longer period of time. So if you're planning as an investor, a small business, it may not matter to you much. But when you think about all of the investment coming onto the continent and all hoping to have 5x return in dollars, then you have to start to think about the macro. How does this pay out? Unless we start to think about investment that then creates the value domestically, it's unlikely that those investments will pay off. And I think the most important item is the level of financialization. And when we think of financialization here, we start to think about very sophisticated products. We're looking at simple real estate financialization, for instance, right? At some level, I think up to 70% of wealth is still held in real estate and related asset classes. Much of that in Nigeria and for most of Africa is actually not within the financial services. They're not funded, they're not on the books of banks, they're not available to be used as collateral. They effectively don't form part of the engine for growth for the economy because those assets are only useful for their primary purpose. So a farmland somewhere in Kenya only functions as a farmland. It is not a collateral for the basis of which capital can then be introduced into the farm. So this is the context, and this is why I feel like the future of banking in Africa has got to be imagined differently. Okay, so the whole story about where banking started is a very interesting question about where did banking is coming from start. There are those who believe that there's some cave in somewhere in Morocco, just lovely little places where modern banking started. But wherever it started, there were two important things that happened. One was people needed an agent of trust. They needed someone in the middle, in the intermediary, someone between when they transact that can guarantee that value is transferred. And the second thing was that they found a way to attach value to real asset that was independent of the value of the real asset itself. And so, for instance, gold is no longer just a mineral that is used to create something, it becomes a financial asset. So this is how we have tried to approach banking on the continent. Traditionally, we looked at the credit, investment, and payments. And I would argue that about 70% of the investment that has come into banking has gone into payments. Very little of that has gone into credit. And where it has gone into credit, we have been able to demonstrate that if you could charge someone a 10% interest rate per month, you could build a good credit business. Well, that's not a good credit business. That's just a business where you don't have to truly collect, because in that instance, the quality of your credit becomes irrelevant. A good credit business is one where the quality of decision continues to improve significantly over time to the point where the cost of credit is approaching zero. So I don't think that we have made any investment, any serious investment in building a good credit business. And the question then becomes, what does that look like? You know, on a continent like ours, where, again, a lot of issues around identity, issues around the data itself, access to data, trust. What does the good credit business look like on the continent? The good news is that increasingly the technology that is being developed, AI technology, is showcasing how this might be possible, because our ability to aggregate all kinds of random data and be able to extract meaning out of it is so critical to credit decisioning. The bad news is that this algorithm and these decisions were not being designed for the continent. There's not a lot of effort to thinking, how do I bring this technology to look at the data that is on ground and use it to arrive at accurate decisioning? So it's still if we look at the current trajectory, it's unlikely that credit penetration is going to change significantly over the next 5 years, because I don't see the investment that would change that. And there are two problems with credit penetration. One is access, just this ability to get to the people who need the credit. The other one is being able to make a good credit decision and collect. So if you ask me, the future of banking for us would rely on someone paying attention to the fact that we still do not have the capacity to make good credit decisions, and therefore credit penetration is low. And for as long as credit penetration is low, all other aspects of banking is unlikely to grow beyond a certain point. I think, though, that as far as payment is concerned, all we have left now is just micro-optimization, because you do have instant payment that is fairly reliable. Yes, the issue now is moving from instant payment and reliability to security and to risk and to fraud, and that's a whole new space of opportunity, which then ties back to the low trust environment. Because if we don't solve for the fraud that is emerging, then we'll go back to the beginning, which is, I don't trust you anymore. The other challenge we face is that of investment. The problem with investment goes back to the earlier context I said about financialization. You cannot possibly build an investment portfolio of assets that you cannot see. They don't exist in the books of banks. The vast majority of wealth on the continent today is either the ground or underground. Whoever can figure out how to bring those wealth into the financial services system in a practical way, in a way that is not just extractive, but is additive, will then be able to build a financial services system that can grow. Because if you look at the size of banking in Africa today, it's inconsequential really when you look at the ratio to the global numbers. So yes, that's how we've thought of banking in the past. But this is what is emerging now. And this is our thought. Maybe I'll spend a moment here to speak to our own experience. In Sterling Bank, when we wanted to transform, or when we wanted to figure out the future of banking for ourselves, a couple of things we realized. The first one was that there was no bank around us that was capitalized enough to be competent in everything. And unfortunately, most of us were trying to be competent in so many things that we effectively were never really competent. So the first decision was you got to decide what you're going to be good at. And that decision is not just vertical, or we chose what we call the hard sector, which is 5 sectors that are critical to the country: healthcare, education, agriculture, renewable energy, and transport. They're the verticals. But you also have to look at how deep you want to go in each one of them. So for instance, are you going to be the great sales organization that can acquire all this talent? Or are you going to be the great processing organization? Or are you going to be somewhere the risk organization? It was clear to us that of all of the things that we could be doing in the hard sector, the most important thing we ought to do was to be the risk organization. That of all of the fintech innovation we were seeing, there was none that was going to become a risk underwriter for the sector. So we thought that banking needed to figure out that you have to be the primary underwriter of risk. That is one responsibility that banks are unlikely to be pushed away from. I don't think it's going to happen anytime. Part of it is because of the sheer amount of capital that you sit on. Part of it is also because of the regulations that sort of surrounds banking. And so the thought process for us was, let's go into partnership, communities, and platforms. This is probably not something a lot of people out of Africa would understand, but you had to become an advocate for the sectors you want to bank. In other words, you have to sit down with lawmakers and figure out what it ought to be. This is the sort of thing that we were not prepared for, because you could see the opportunity, but there are regulatory obstacles to it that you have to deal with. And so the partnership there is not just with the businesses, it becomes partnership with government. There is an interesting example of how we're expanding our banking network. We'd realized that payment had sort of caught on, but in those spaces, not much else was happening. So you had to charge a lot of money to be able to make payment work for you. So we figured this distribution network that we've created for agent banking, what else could we do with it? So we found ourselves having to sit down with government and realizing that last mile healthcare was a big problem for them. And so what you had as agent banking suddenly became a last mile healthcare provider, because all you had to do was to bring in telemedicine and connect all of that, because you've got power, you've got internet connectivity. And so before you knew it, you had a doctor online, and you're able to shift healthcare services from where people live to where they work, because we also realize that there's been a demographic shift. People want to access healthcare where they work, not when they're at home. Right, so that sort of partnership moves beyond just you and your customer. It goes to you and the government. You have to think about it in a broad range. And the other point was, we then realized that we had to start to convene communities. So one example was agriculture. Everybody knows how the significance of agriculture in employment. So the question was, why are we not increasing productivity? So we went with the usual financing. We even tried to build a digital platform that tokenized commodities, and just the smart things that smart people do. Didn't go very well. Part of it was because you didn't have the community around which these things would be built. We assume those communities exist. We assume they're talking to each other. So we started the Agri Summit Africa, which essentially bring together people from different walks of life that are in any way involved in agriculture, from policymakers all the way to the farmers, sometimes to the consumers. And those conversations have now led to building communities around it. It's an annual event now. We now have an online community around which products are now being built. So the future, therefore, is not you thinking, I'm a bank, I'm going to do banking stuff. It's you thinking, how can we make this work? And a bank is a very good convener because there's a lot of trust already vested in you. We've moved in from there now. We also hold the Africa Social Impact Summit with the United Nations. We've co-convened with the United Nations for 3 years now. And what that does is exactly the same thing in impact space, right? So not just being a bank, but bringing that community, and that's where the banking product actually come out of. It's those conversations that lead you to say, this is the problem to solve. And ultimately, platforms. Some comment around distribution. We, like everyone else, had close to 200 branches. These branches are incredibly expensive. We've got this huge tech infrastructure you have to make in all of them. And we started a process of converting them to cafe. Our thought process is very simple. Nobody wants to go to a bank. Everybody wants a cup of coffee, right? So that should be pretty straightforward. What we now started off as cafe has now become co-working spaces. They are still coffee store. They still host the bank. And at a fraction of the technology cost, they can carry out every single thing that we could do in the bank before. Now we have, some of them now have a studio room for podcasts, creative spaces so that people come in there. Again, this idea of there is bank and then there is life, that's gone. I think we've got to be able to integrate banking into life. So if you think about embedded banking, that is the physical embodiment of embedded banking, and it's from there that you can then do the digital expression of it. We now have over a dozen cafe, probably the single largest coffee chain in Nigeria right now, because we haven't got any of the other coffee chains. And they're still providing banking services. One thing we learned in that process was that same product, same platform, same tech. When you do the customer satisfaction survey, it was about 15% higher for the customers that were served in the cafe compared to the customers that were served in the branch. So it's not really your service, it's how people feel about you. So yes, that's how we see the future. Now this takes us to where, from this I'll probably try and point out some of the opportunities. Increasingly, less and less of banking has to do with people and what they do on the day-to-day interaction with customers, and more with what we do with data, right? And we talk about it all the time, but I don't think we understand at full maturity what that means. I think it's going to get to a point where the ratio of our investment in technology, all the way from data to encryption to safety, to the ratio of our wages, we're going to get to a point where I think we could be spending 9 times as much on technology and infrastructure than we're going to spend on people. And it's just simply because it does it better. It just does it better, especially when you're looking for a low-cost outcome. So the point is going to come where it just doesn't make economic sense anymore for people to serve people in banking, except you're doing wealth management. And we think that wealth management is just a lifestyle game now. Even the decision-making itself is not going to be because of some super brilliant person in a room who will figure it out. He's just going to take that information from you and get that decision from something much more capable. Right, so I think that where banks need to think carefully, what we've done in the past is credit, digital, operational, all of that. I think all of that is going to come down to how good are you as a risk manager? How good are you at identifying what is real and what is not, who is good and who is bad for credit. That is going to be the single most important thing. And it's not going to happen in a traditional way where we had all of that. It's going to come out of just one single decision point. Can I tell if that person would pay back and how much he can pay back and how well he can pay back? That's on the credit side. Can I tell if that payment is an authentic payment, is a genuine payment, authorized? Or can I tell if that person is who they say they are, right? That's just all that is going to matter. Because once that decision is made, anyone can render any of the other services that we have in mind. And that takes me to data collection. It is going to remain for a long time the most difficult part for us, because the number of spots from which we need to pick up data to be able to arrive at a decision, it's not getting smaller. When we don't get more, data is not being consolidated in ways that are more meaningful. On the contrary, you're finding out that there are so many other ways that data exists that you couldn't collect before, but that if you could, would make sense in your decision making. So I think data, AI and all of that, I think someone can always buy that, but you're not going to be able to buy data in the form that you want it. So whoever lays out the means to collect data will do a great job. And finally, what the customer feels about you. So is it a Cafe One or is it a bank branch, right? What do they feel about you? Same product, how they feel about you determine your cost of acquisition and your retention, your cross-selling. Okay, so I'm in London, so I have to mind something. So this is what I think, this is where I think the opportunity is for anyone who is looking to innovate in banking for the continent. The big one is identity management. They're probably close to 60 different nationalities. Now we're about 56, but I'm sure by the turn of the century, there'll probably be close to 60 different countries that have 60 different identity management, which means that each one of those countries still remain disconnected in terms of figuring out who is who. If I travel to Ghana the next day, whoever is going to provide the digital service for that is not able to do it effectively. Anyone who can make it possible for you to be able to integrate all of this identity management in a cost-effective way, there's an opportunity there. So all of the Africa Continental Free Trade that we're working on and all of the Pan-African payment system would rely on an identity manager that can consolidate the continent. Cost-effective decisioning. So the reason it's so expensive for credit to lend to the low-income communities, it's that first there is the cost of access, which we've been able to handle with a bit of agent banking, but there's also the cost of the decision. It's a lot more expensive to make those decisions compared to the microcredit that we're looking to give out. You cannot offset that by charging them 10% per month. That's not an effective way to scale. The only way we can begin to scale into those communities is to be able to arrive at effective decisions that are cost efficient. And that means that we deploy some of the most cutting edge technology, but we have to be able to deploy it at a cost that makes sense in the communities we deploy them onto. And so part of that is just to take out the things that are not needed. A lot of the technologies that we get on the continent has about 80% components that are not required for the work that we want to do. So who is going to begin to think through how the lighter version of these systems can actually be deployed? As it took Netflix, Apple, a couple of decades to find out that you couldn't bill $100 subscription on the continent and get a lot of people. Hopefully we don't have to take that much time. I would come back to financial inclusion. So the battle that we fought over the last decade is how to have seamless operations. Sounds easy, should be easy, except I run a power company, I run a security company, I have a logistic company, I run a real estate company. You can imagine all the infrastructure that your municipal government provides. I have to learn to provide them efficiently. And for my telecommunications, I have to have multiple layers of telecommunication assets to be able to attempt a seamless operation. And that's just what it is, right? For us, figuring that out is how we're going to also reduce the cost of banking. Today, it is incredibly expensive. So whatever fintech is out there trying to solve a problem, think about how all of that cost can become obsolete in your strategy. How can you deliver operations that does not rely on that sort of cost? I've talked about asset financialization. the pathway to growing financial system is to effectively increase not just the size of the assets, but also the type of assets. Right now, the assets that we have, and specifically financial assets like fiat currency, do not provide the trust that we're looking for. So there's a difference between trust between transacting parties. There's now trust in the asset you're holding. In a continent where devaluation has become a very frequent way of balancing the books and wiping out a few unfortunate people who are sitting on cash, that trust level is declining. So beyond anyone else, I think we need to figure out how to financialize assets and make them alternative to fiat, which is why I think the technology that has delivered Bitcoin is incredibly beautiful. But I think the real use case for it is for me to have an asset that sits on, 100 tons of gold somewhere in one locality that is still on the ground. But because it is there and is verifiable, it can start to play a role in how we grow the economy today. It could be coal or crude or, I don't know. The forest somewhere in my village could be part of a financial asset that then gets on the bank of books because they have value that are verifiable and therefore should be exchangeable and therefore should form the basis for credit. And then both embedded distribution and financial inclusion are somewhat one and the same for me. I think the last mile banking on the continent is not going to be done by banks. I don't think it needs to be done by bank. I think the model, there's a bank in Australia that I find very intriguing. I think it was called Bendigo Bank. And what they had done was to work with the communities to provide certain infrastructure, and then the bank would just come in with its own risk management and technology, and they created this. That's the kind of embedded banking in communities that I see and hope emerges on the continent. Because we have to use stranded assets to be able to deliver financial services. We cannot make that additional investment and hope to deliver. But there are a lot of stranded assets in existing communities, in even large families. I think, for instance, that some families are so large that they should actually form their own bank. And which is what you do with extended family. And then what you do is you bring in the product, you bring in the system to support them. And finally, banking is not payments. I think the future of banking is not going to be found by stargazing into the payment space. I think it's going to be found by asking, how do I enable the productive factors, human factor, the assets, and that's going to come from access to credit, for a start. And it's not just access to credit at the micro level, it's access to credit for sovereign. Currently, the way access to credit is structured, Nigeria, for instance, had never defaulted on a sovereign loan, but Nigeria pays 10% today on foreign currency borrowing. I know of some countries, not to name names, that have defaulted every decade, and their cost of credit is so far below. The continent is going to continue to have limited access to funding for as long as there's that mispricing. And the problem with the mispricing is that it's self-fulfilling. Because if you charge me 3% or 4% and give me 50% loan, then I have the capacity to pay. But if you think I'm not going to pay and you charge me 10% and then you give me a 5% loan, then I'm not going to pay, because by the time I finish paying the interest, I'm going to struggle with the principal. So self-fulfilling, not our problem to solve, but who knows, there might be some founder here who is thinking in that way. So I'll round up by saying there is a space where the future of banking on the continent is not different from the rest of the world, right? In that regard, we're going to talk about hyperconnectivity, open banking. I think that open banking is already here. We just haven't figured out what it's going to do to us. And that is because while we are thinking and worrying about it, those that have the most opportunity to take advantage of it haven't really thought about it yet. And part of that is they don't have infrastructure, or they're still dealing with primary issues around their own core businesses. So if you look at the retail stores in Nigeria, for instance, the last thing on their mind right now is how they can offer banking services. They've got other problems to deal with. But the day they sort of go past that, we'll see a huge change. But all of that nothing we do is going to matter unless we can figure out how to deal with data security, how to deal with the fraud, information security issues, of which I think we haven't even begun to come in. I mean, there are policies that have been set, but I think in practical terms, we're still far away from doing what needs to be done. And finally, all of this need for technology will only make sense if we can start to domesticate the technology. And it's just because of the cost differential. You can't pay someone $50 an hour to build product for someone who is earning $5 a day. You can't. It's not sustainable. You've got to be able to figure out how to domesticate some of the technology so that you can scale it, so that it gets to a point where it now is net additive to the economy. So, well, I think this is all I could think of. Hopefully it did say something about the future. It's an example of why we think the future, the way we envisage it, is sensible. We had a corporate venture that led to the creation of a new bank. It's called the Alternative Bank Limited. And as we tried to figure out who our customer was and what we were going to do, we realized that Nigeria has a huge power problem, right? So all power, we decided we're going to build a system around access to credit for renewable energy. But also it became a marketplace for renewable energy. So you could go there and buy your solar panels and your battery. But all power became a product on its own. The sole purpose of all power is to allow anyone who is thinking of changing their power source from the unreliable grid to renewable to just go in there. There's a credit engine built in there. There are partners that have all been aggregated. There are franchises there, the products, and you get what you want, and so you have your payment. We also realized that for us to be able to sell credit, it's interesting how Nigerians don't like credit card. They actually don't like credit card. We still don't understand why, but they don't mind buying things on credit. So in an attempt to introduce credit, we ended up creating Altmore, which is an e-commerce site. The only thing different is that it's deferred payment. I mean, we've seen some of it come up here now. Same sort of journey took us to all travel. So what is happening is we're talking to the customers and we're not offering them a bank. We're saying, this is a specific problem. Same problem. We realize, for instance, that most banks in Nigeria would only finance new cars. Most buyers could only afford used cars. So all travel is the solution for that, for financing. And all invest and all pay. So this is how it's connected. I would round up by hopefully talking about Waste Bank, which is where we realize that, again, the agent banking system we've deployed doesn't really create, most of it is we charge the poor communities for access to payment services, right? That's the summary of it. Waste Bank is where we say, what can we do in this community so that they actually create wealth? And so suddenly we built a waste recycling company that accepts plastic as part of the money you can deposit in your bank. So you go into that space and you could just deposit plastic and you get the tokens in your wallet, which you can then spend. Now, this simple thinking is going to be at the heart of how I think banking would grow. Idea that whatever infrastructure you have that is stranded has multiple use. But most importantly, whatever you do, you've got to help those communities to create wealth. If you're not doing that, you're fighting over a limited pie, and I suspect that the pie is about to run out. So thank you very much, and really nice speaking to you.